Some people say things are not looking good for gold recently. More than 10 billion has been pulled off from one of the biggest ETFs, and the fund's physical gold assets are also selling off. In the meantime, Bitcoin has reached $67,000, and some investors started to look at Bitcoin and other cryptocurrencies as possible inflation hedging assets, even though they didn't exist during the last time of serious inflation. The famous Paul Tudor Jones hedge fund manager told CNBC recently that he prefers cryptocurrencies over gold as an inflation hedging asset. So banks and hedge funds can no longer ignore cryptocurrencies, as it would have a devastating effect on their P&L and it would be ignorance. I hear many new traders saying that gold once was a good inflation hedging asset, but not anymore. And Bitcoin, on the other hand, is a good inflation hedging asset. So this brings us to the question, is gold really dead? Let's look into the data and let me show you some charts with my humble experience working in banking and finance for over 9 years. Point number 1, CPI. Now gold tracks CPI inflation in an irregular way. They both rise over time, but the relationship is uneven. Gold is a real asset and there is a fixed quantity of it, and people have liked it for millennia, and so it has held its value. Point number 2. In reality, what gold tracks closely lately is the real rates. That is the opportunity cost of owning the yieldless, inedible, shiny metal that has limited industrial use. Gold is heavily driven by monetary policy, and the 10-year yield, my friend, is a derivation of the monetary policy and investor sentiment. Point number 3. Now, Bitcoin in its short life has shown no relationship to inflation, except that they both go up, which is what you might expect for something that might be a currency at some point in the future. But right now, it's only a vehicle for speculation. Point number 4. So Bitcoin is a real asset with fixed quantity, and people have liked it over the past years, so it could be a good store of value, for all we know. But there is no particular reason to describe it as an inflation hedging asset. If it correlates to anything, it only correlates to speculative appetite. I mean, look at Squidcoin and other shitcoins. Literally billions of dollars have been wiped out overnight from the market. At the time of making this video, talking about gold as an inflation hedging asset may be a bit sloppy, but talking about Bitcoin as an inflation hedging asset, it's just insane. Now, at some point in the future, Bitcoin will definitely take its deserved place and will play an important part in our financial system. So ignoring it would be arrogance. But right now, gold is still king during times of high inflation. So now it's time to look at the technicals and the midweek forecast. So starting on the weekly time frame, you can see that gold has broke through this massive bearish trend line on 8th of October with an impulse move to the upside. If you go down to a lower time frame, you can immediately see that this didn't last long and gold wiped out all of the 7% gain it racked up for weeks. So the million-dollar question is whether this was a fake out or not. I cannot see the future, but what I can tell you is look out for these things in the coming weeks. And the first scenario I'm going to give you is obviously bullish, because the things I explained to you at the beginning of the video, why I think gold is still one of the best inflation hedging assets and why I think that gold is going to go up, is because gold is an inflation hedging asset and inflation is going to stay with us for the coming years. There is no alternative for inflation hedging. So here comes the bullish scenario. The first thing you need to watch out is this bullish trend line. If you put the Fibonacci retracement tool from the beginning of the impulse move to the top of the impulse move, this was the breakout from this bearish trend line. You can see that so far price has respected the 78.60, which is a well-known entry point for the Fibonacci. But if you go down to a lower time frame, you can see that it's not looking good, because gold started to gravitate again back to the 70.84 level. Whether this is going to hold or not, I don't know yet, but I'm in a long position from 1782 because it lines up with my Fibonacci, the support and resistance level, so I have multiple confirmations that the price should bounce back. Now, the problem is we're not out of the woods yet, because price is still in a bearish market structure. So the confirmation I'm waiting for is the break of any bearish trend line, a retest, and then we have a confirmation that price is going to continue to the upside. Until then, I wouldn't be comfortable to enter into more long positions, so I have only a small risk, risking about 0.5% of my account, because we don't have enough confirmation that where is price going to bounce back. And if we just switch to a higher time frame, you can see that we have still some room to the downside to reach this bullish trend line. And if I go back to the daily time frame, if I just adjust the Fibonacci to this level, you can see that we have so much room to the downside. That's why I say Guys, be careful going long, because I know that I said that gold is a perfect inflation hedging asset. It could be that we see a short-term movement from gold to cryptocurrencies because that's the current craze, that's the current hype. But overall, long-term, gold is the ultimate inflation hedging asset. I know everyone loves cryptocurrencies, but you have to accept the fact that gold has been on the market for decades, and there are much bigger market players in the hedge fund and banking industry who use gold as a hedging vehicle. So going back to the bullish scenario, what I want to see is, let me just delete the chart. So what I want to see, if we look any level, whether it's going to be 1780 or it's going to be 1723, the things you need to look out for is obviously the first thing, you draw your bearish trend line, try to touch as many wicks as possible. You can see that price is creating lower highs and lower lows, and what I want to see is a break of market structure, so price to break the previous lower high. Once it does, every impulse move and every break of market structure is followed by a retracement. So when it does, it comes back to the trend line, and then it should give us a bullish market structure. If you see any kind of M patterns or higher highs and higher lows, this is not magic, this is not some over mystified things. We're looking for clear market structure. So once you see this market structure on a lower time frame, whether it's H1 30 minutes or H4, you can be confident that price is going to continue to higher. And once you see higher lows and higher highs, you can put your trend line, and you have to watch every retracement and every pullback to this bullish trend line and go long. Now, because it didn't happen yet, I only have a small position at the current price level at 7. I entered at around 1783, 1784. So currently I'm in a little bit of drawdown. So just to show you my position, I entered somewhere around here. I have my stop loss at 1780, and obviously the first take profit level will be at 1811. The second one will be at 1844. But I'm not going to add any more positions to the current one because we haven't broken the bearish market structure. And if you go to a higher time frame, you can see that things are not looking too rosy, because we have these massive big ass red candles. And you can see that we still have about 100 or 200 pips to the downside to catch and clear liquidity at 1758 level, and then the next one should be at 1722, 1726. So we still have a lot of room for downside potential, and it's a little bit scary, but hold tight and do not waste your money. Do not risk and blow your account, because once gold moves to the upside, it moves very quick, the same way as it moves to the downside really quick. So what I would advise, guys, is be patient with gold. It does all the time, shakes out all the weak hands, all the new traders, and that's why brokers get shitloads of money, because most of the people are not patient. And to be fair, trading is a long-term game. It's a marathon and not a sprint. So potential buying opportunities come from 1781 level, and the second one is 1755 and 1722. But be careful with the buys, because currently we see a massive sell-off on the market. Now here comes the second scenario, selling gold. Now I showed you this bullish trend line, which price so far respected really well once, twice, 3 times. If we move a little bit, it could hold as a really good support level, but I don't have enough confirmation in terms of support and resistance, because if you look left on the chart, in the past couple of weeks, gold has been a little bit choppy. So you can see multiple support and resistance levels and then going down. So the market was a little bit dicey. Therefore, I cannot strictly rely on support and resistance level. Well, obviously, one of the strongest resistance level was at 1680, because you can see how aggressively gold pulled back from this level. This was the flash crash. So the second scenario, which is bearish, if I see that this bullish trend line is broken and price comes below the previous higher low, I'm going to wait for a retest at around 1771. So if price trades below at 1780 level, I'm going to look for more short possibilities and more short entries. So once again, breaking the trend line, breaking the market structure, comes back to retest it, and then I'm going to sell it all the way to 1722. And if it reaches 1722 or 1725, I'm going to pull out all my money from the market, from the gold market, and close down all my positions. And I'm going to put back my hands and sit tightly, because I don't want to lose and risk money, which, you know, I need for the good opportunities. And that's what I advise to you. Do not risk too much money, because right now we don't really know what's happening with gold. You know, inflation is going up, gold is an inflation hedging asset, but we see a massive sell-off in the market. And also cryptocurrencies, some of the cryptocurrencies are selling as well. So what we see is uncertainty in the market, and the best way to protect your capital against uncertainty is sitting tight on your hands and do not trade. If you see any good opportunities, you have enough confirmations, then go. If you do not see, then don't trade at all. By the way, I'm sending daily analysis and setups to my team. Some days I send more, some days I send less, depending on the opportunities I see on the market. If you're interested, go to my website, alphafx.eu. Go to the purchase tab. I have monthly and lifetime subscriptions. If you have any questions, hit the contact button, send me a message, or just say hi. This was the weekly video, but do not leave yet. If you get any value out of the weekly video, I want you to subscribe to the channel, hit the like button, and leave a comment under the video. This is the Alpha FX.